How do interest rates affect aggregate demand and inflation? Have you ever wondered how the rates we hear about in the news can impact our everyday lives? Interest rates play a significant role in shaping the economy, particularly in how they affect aggregate demand and inflation. Let's break it down in simple terms. Interest rates are essentially the cost of borrowing money. When these rates go up, borrowing becomes more expensive. This means that consumers are less likely to take out loans for big purchases like homes and cars. Businesses also hesitate to invest in new projects or expand when borrowing costs are high. As a result, overall spending in the economy tends to drop, leading to a decrease in aggregate demand, which is the total demand for goods and services. On the flip side, when interest rates decrease, borrowing becomes cheaper. This encourages consumers to spend more and businesses to invest in growth. With more money flowing into the economy, aggregate demand increases. This can be great for economic growth, but it can also lead to inflation if the supply of goods and services cannot keep up with the rising demand. Now let's connect the dots between interest rates and inflation. When aggregate demand rises quickly due to lower interest rates, it can create upward pressure on prices. This happens because there are more dollars chasing the same amount of goods and services. If supply cannot adjust quickly, prices go up, leading to inflation. Conversely, when interest rates rise and aggregate demand falls, there is less pressure on prices. This can help to lower inflation, as fewer dollars are competing for the same goods and services. Central banks, like the Federal Reserve in the United States, use interest rates as a tool to manage economic activity. By raising rates, they can cool down an overheating economy and help keep inflation in check. It's also important to consider how interest rates influence inflation expectations. If people believe that prices will rise in the future, they may ask for higher wages. This can create a cycle where inflation continues to rise. Central banks aim to manage these expectations by setting clear inflation targets, which helps maintain confidence in the economy. In practical terms, when inflation is higher than desired, central banks often increase interest rates to reduce aggregate demand and control inflation. Conversely, if the economy is sluggish and inflation is low, they may lower interest rates to encourage spending and investment. In essence, the relationship between interest rates, aggregate demand, and inflation is a balancing act. Higher interest rates generally reduce both aggregate demand and inflation, while lower rates can boost demand and potentially raise inflation. Understanding this dynamic is key to grasping how monetary policy influences our economy.